Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
I'm Jamie.
And I'm Alex. Right, this week. Well, the theme really feels like chaos versus control, doesn't it?
It certainly does.
You've got the government struggling a bit, the Ministry of Justice accidentally releasing 37 prisoners. I mean, really.
Yeah, quite something. And then you contrast that with, well, us, the financial services industry, expected to operate with, absolute precision.
Exactly. And that contrast, it goes right into Westminster, doesn't it, with Rachel Reeves?
Oh, absolutely. The Chancellor breaking, decades of Treasury protocol? That pre-budget briefing?
Wait,
Wow.
It wasn't really policy, was it? More
Signaling. Totally. Rolling the pitch for tax hikes, basically. It just screams uncertainty about public finances. And that means uncertainty for, every single firm operating here.
So our deep dive today really has to focus on that contradiction, that fallout. You've got regulators telling firms explicitly, look, embrace managed risk, get rid of the clunky controls holding you back.
Yeah, less red tape, basically.
But then, in the same breath, they're hitting firms with record-breaking fines for, absolute core compliance failures.
It's a real tightrope walk.
It feels like being told to take the brakes off, but getting punished if the engine, sputters even slightly.
It's definitely a high-stakes environment right now. So maybe let's start with the macro picture. Threadneedle Street is certainly feeling the pressure.
Right, the Bank of England, holding the bank rate at 4.0%, but only just.
Yeah, razor thin, 5.4. That tells you something.
It's more than just news, that split, isn't it? It's a warning flare. 4 members actually voted for an immediate cut down to 3.75%.
Which means Governor Bailey had the casting vote. They are, as you said, right on the verge of cutting.
So for our listeners, the risk teams in retail banks, what's the key takeaway from the bank's analysis?
Well, crucially, the bank was explicit. They said the uncertainty around the budget that pre-briefing we mentioned, it's a major drag on growth, on investment.
And not just short term.
No, they expect the impact to last well into 2026. So if the MPC is this split now, downward pressure on net interest margins, your NIMs, it's basically imminent.
So banks need to prepare for that squeeze. When do you reckon?
You've likely got until early December, maybe mid-Q1 2026 at the latest, before those cuts really start to bite into profitability models. Margin compression is coming. Get ready now.
And that pressure, it feeds right into what Rachel Reeves is saying, doesn't it?
Absolutely. Her speech made it crystal clear. Tax rises are, and I quote, inevitable to fill this reported $50 billion fiscal black hole.
Pretty blunt messaging. Each of us must do our bit.
Yep. And the markets. They reacted immediately, priced in that tighter fiscal policy.
So we saw the pound dip, lowest since April against the dollar, I think.
That's right. And UK government bonds, gilts, they actually rallied, which sounds counterintuitive, but it reflects the expectation that tighter policy now might mean lower inflation, maybe lower long-term rates later.
It signals those stealth taxes everyone's talking about.
Exactly. And we're already seeing the political fallout, aren't we? That rumored tax on limited liability partnerships, LLPs.
Yeah, the legal sector seems genuinely alarmed. The Law Society warned it could damage the UK's $60 billion legal services industry. Why is that LLP structure so critical?
Well, it's fundamental, really, for how these big global professional service firms, law, accountancy, how they structure themselves, it gives partners flexibility plus tax efficiency.
So targeting it isn't just a small tweak.
No, not at all. It potentially threatens London's competitiveness as a global hub for that kind of talent. It feels like sacrificing a structural advantage for maybe short-term cash.
Speaking of structural advantages, AstraZeneca. Wow. Talk about a masterclass in, perfectly legal tax avoidance.
Oh, that was fascinating, wasn't it?
Yeah.
They got shareholder approval to keep their London listing, but also list in New York. Smart move to widen the investor pool.
But in doing so, they've basically exposed a massive flaw in the UK's 0.5% share stamp duty regime.
This is the clever bit. To make the New York listing work, UK buyers of AZ shares can now hold something called a depositary interest, or DI.
Okay, a DI. What's that exactly?
It's basically a claim on the underlying share. The actual share is held by a third-party depository, often outside the UK.
And the loophole is?
The DI gives you the same ownership rights, dividends, voting, all that. But crucially, under UK law, it's technically a claim, not a direct share transfer.
Yes.
Now, 0.5% stamp duty.
Bingo.
not subject to it. As Nils proudly put it, AZ has effectively killed stamp duty on shares.
And the cost to the Treasury.
Estimated $200 million a year just from AZ transactions. But the bigger risk, if other FTSE giants copy this structure, and why wouldn't they?
Then the whole £3 billion annual stamp duty regime could just collapse.
Precisely. It's not a future problem for the Chancellor. It's an immediate $3 billion headache that basically forces reform, a real time bomb.
Okay, let's shift gears. From fiscal chaos to financial crime. And the theme here seems to be absolutely zero tolerance.
Yeah, if regulators are pushing for managed risk on one hand, they're definitely bringing the hammer down on core control failures. Record fines globally this week.
And it's the type of failure that's interesting, isn't it? Specific procedural stuff, like JPMorgan in Germany.
Right. BaFin, the German regulator, hit JPMorgan SE with a record $45 million fine. Significant shortcomings in AML controls, they said, but the specific issue.
Systematic late filing of suspicious activity reports SARS between late 2021 and late 2022.
So just to be clear for everyone listening, a SAR is what a bank files when it suspects something criminal might be going on.
And the fine wasn't necessarily about missing the crime itself, but about the delay in reporting the suspicion. It signals that timely procedure is absolutely critical.
Exactly. And then you look at the crypto sector. Coinbase Europe got fined $21.5 million by the Central Bank of Ireland for AML-CTF failures.
A different kind of failure there, though, more about scale.
Yeah, massively. They failed to properly monitor over 30 million transactions, worth more than 176 billion, because of system faults. Wow. 30 million transactions.
And that failure meant they had to go back and file 2,708 retrospective STRs, suspicious transaction reports.
Okay, so SARs are about suspicion, STRs are about transactions already flagged, JPM fined for being late with suspicions, Coinbase fined for basically being unable to monitor transactions properly in the first place.
Both point to systemic failure, absolutely. But the Coinbase one really highlights the danger of scaling up tech without ensuring your compliance infrastructure keeps pace. Huge operational risk.
And linking this back, the vulnerability isn't just tech, is it? It's people, insider threats.
That Eurojust operation was staggering. Dismantling a global credit card fraud network worth at least $300 million. Attempted fraud maybe double that.
And the arrests, 18 people, including
5 executives and compliance officers from 4 different German payment service providers.
right there, compliance officers.
Involved.
It confirms that blurring intersection between cybercrime and white-collar crime. This wasn't just external hacking. It was active collusion from the inside. People paid to uphold the rules were breaking them.
That's got to send shivers down the spine of every head of compliance, questioning your own team.
It really does. And it also throws light on another pressure point. Sanctions compliance. Revolut freezing accounts of Russian and Belarusian citizens in the EU without permanent residency.
That was in response to the EU's 19th sanctions package, right?
Yeah. It just shows how geopolitics forces firms into these really complex, rapid implementations overnight. Huge disruption for customers, but compliance has to come first. It's an immense operational challenge.
Right, okay. Just a quick reminder, if you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more compliance professionals like you.
Especially if you need more detail on how these new FCA rules, which we're about to get into, apply to your specific area. Subscribing means you won't miss our focus briefings.
Okay, so let's pivot. From that zero-tolerance environment, those huge fines, to the other side of the coin. The shift in regulatory philosophy, this is the core contradiction, isn't it?
It really is. While the fines are landing, the FCA is simultaneously signaling a major change, urging firms to take more managed risk, not less.
Sarah Pritchard's speech seemed pivotal here, the deputy CEO at the FCA.
Absolutely. She urged chief risk officers, CROs, to embrace responsible managed risk under this new outcomes-focused framework. But the really striking bit
Was telling firms to help the FCA bust myths?
exactly. And specifically, she said firms can stop using clunky risk warnings if they're just custom in practice, not actual regulatory requirements.
That feels huge and challenging. For years, compliance has felt like adding more warnings, more caveats, covering every possible angle.
It has, taking the most cautious interpretation possible to eliminate liability. But the FCA's view seems to be shifting. They're saying the opportunity cost of inaction, failing to innovate, failing to serve customers well, might actually be greater than the risk of some negative outcomes if you try something new.
So if the FCA is saying, go on, strip out those warnings that have been standard practice for 15 years, where does a CRO even start? I mean, are you genuinely covered if something goes wrong afterwards if a customer complains?
That's the million-dollar question, isn't it? The protection isn't a blank check. It comes from embracing the spirit of the outcomes-focused regime, not just ticking boxes from the old rule books.
So it's about judgment.
Sharper judgment, absolutely.
Yeah.
The FCA isn't offering a liability shield. They're demanding firms document why they removed a warning, demonstrate the product still delivers fair outcomes. It's moving from defensive, passive risk management to active, engineered risk management, a much higher bar, requiring real professional judgment.
And that push for sort of smarter risk and better outcomes is mirrored in policy too, isn't it? Treasury's financial inclusion strategy.
Yes, that's a landmark strategy, and it directly impacts retail banking operations. Several core pillars.
Let's run through them. Education first.
Right. Financial education is set to become compulsory in primary schools in England for the first time, legislated through the Children's Wellbeing in Schools Bill. That's a long-term investment in customer capability.
Okay, number 2, access. This idealist accounts pilot sounds interesting, but tricky.
Very. Partnering with third sector groups, it forces banks to innovate on KYC, know your customer rules. How do you safely onboard someone without the usual ID while still meeting AML rules?
Requires different data, non-traditional checks.
Exactly. Leveraging third-party data, maybe behavioral or contextual proofs that the regulator signs off on. Then there's credit, pillar 3.
Fair for all finance, piloting a small sum loan product under £1,000 with a mainstream lender.
That's a direct challenge to banks, isn't it? Fill that affordable credit gap. Compete with high-cost lenders. It demands new models affordable, low margin, high volume, but managing risk carefully.
And finally, resilience. Savings.
Yeah, FCA statement, providing clarity for employers to launch payroll savings schemes backed by a national coalition of employers. So it's a multi-pronged approach. Policy, funding, nudges, all pushing banks to innovate on KYC, credit risk, and savings.
Innovation. That
Yeah.
brings us neatly to AI. Adoption seems to be really accelerating in banking.
It is. The Wharton GBK report called it accountable acceleration. Gen AI is pretty mainstream now in finance. 82% using it weekly, apparently. 72% measuring the return on investment.
And seeing positive returns.
3 out of 4, according to the report. So firms are definitely investing, looking for those efficiencies.
But then the market gets jittery. We saw that sharp tech sell-off November 6th. NASDAQ down nearly 2%. Fears of a speculative AI bubble.
Classic tension, isn't it? Firms are betting big on AI for the future, but investors are worried about today's valuations and volatility.
And the regulators are watching closely too.
Definitely. The CMA, the Competition and Markets Authority, is speeding up its scrutiny of concentration risk, particularly AWS and Microsoft dominating cloud services.
Makes sense. If basically the entire financial system relies on just 2 cloud providers, what happens if one has a major outage? Big questions about systemic risk and competition.
Huge questions.
Right. Okay, let's wrap things up with some quick hits, rapid-fire updates to keep everyone fully briefed.
Okay, first up, motor finance redress. The FCA has extended that consultation deadline. It's now 12 December.
So final rules likely Q1 2026, Feb or March.
Looks like it. Firms need to use that extra time to really nail down their potential exposure.
Next, Post Office Horizon. Sir Alan Bates, the hero of that campaign, finally secured a settlement. 7 figures, reportedly 4 meters, 5 meters.
Long overdue. The government's confirmed over $1.2 billion, now paid out to over 9,000 victims. Still an absolute scandal of governance, though.
Branch closures. The relentless march continues. Lloyd's confirmed another 218 closures for 2025.
And the impact is really hitting communities. Largs in Scotland, 11,000 people will be left completely bankless when its last branch goes. Puts real pressure on that LINK hub threshold, the 10,000 adult thing. Political heat is rising on physical access.
Okay, other headlines. Revolut freezing those Russian and Belarusian accounts under EU sanctions. We touched on that.
Labor's U-turn on the 28 billion pound green spending pledge, a sign of those fiscal pressures we discussed earlier.
And that BBC investigation exposing a high street crime network using ghost directors ties back to insider risk, doesn't it?
It really does.
Yeah.
Systemic fraud often has an internal element.
So let's try and pull this all together. What's the big picture takeaway for the compliance and risk professionals listening?
Well, as we said at the start, it's defined by this central contradiction, really. On one side, you have regulators, especially the FCA, pushing firms hard. Embrace managed risk, get rid of unnecessary defensive controls, simplify things for customers, that whole myth-busting agenda.
Take the brakes off, innovate, grow.
Right, but, and it's a huge but, at exactly the same time, those same regulators are bringing down the hammer with record fines. JPMorgan, Coinbase. for failures in absolute core fundamental compliance.
Especially where internal integrity just collapses, like those payment provider compliance officers involved in massive fraud.
So, the message seems to be, yes, defensive, tick box compliance is dead. Forget just covering your back. But what replaces it isn't easier. It's harder. It's a higher stakes game.
Requiring better judgment.
Better judgment, yes, but also impeccable foundations. You need almost industrialized perfection in your core AML, controls your SAR filing, your transaction monitoring, your internal vetting, essentially. You have to earn the right to take the strategic risks the FCA now wants you to take for growth.
So become a sophisticated risk engineer.
But no, you'll be absolutely punished if the foundations aren't rock solid. It's a demanding balance.
That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.